Mary, Henrietta, and Ronell. If you guys want to kick off by introducing yourself or kick off with the topic while you introduce yourself, I'm going to hand it over to you, and the floor is yours.
We thought we'd start out this morning with one of the hottest trends, obviously, in the industrial sector, and that's the continuous digital transformation of not just the back and front office. That's sort of what everyone is used to, but now it's really gone from product development to engineering and manufacturing, right through all the supply chains. So we just purchased at Hamilton Robinson a company out in California, and they're actually building what I call the warehouses of the future. So we seldom think about what it takes to get a tomato or maybe a strawberry from the farm through a distribution center to your doorstep, completely unbruised. So, you know, when we press place order and the product arrives in 1 hour, you know, nobody really thinks about what did it take to get that there. And the automation and the robotics that now go into these new warehouses are just absolutely incredible. But with that comes a whole new host of concerns, from ERP implementation to cyber risks. And maybe we could hop over to Ronell to expand on that.
Hi, good morning, everyone. I agree with Marianne. This is a really exciting group, great cross-section of folks. Happy to meet you all. I am a partner at Loeb & Loeb. I came to this group through Lloyd Rothenberg, who has attended many of these, and I'm so thrilled that he offered up this opportunity. And so I am a partner in the Capital Markets and Corporate Group at Loeb. We are a multi-service firm in 8 offices between the US and Asia. My practice, middle market M&A, a lot in the industrial tech space, energy. I've done healthcare tech. And so this was obviously a topic that was exciting and could very well speak to. And like everyone else has been mentioning, also now in the SPAC space, because that's just kind of where the natural trend is right now, pulling on the M&A side of the house. And to what Carrie had opened up and is speaking about, we're certainly seeing a lot more of this when we enter and we talk to companies and we represent the companies in terms of a lot of the things that we see. And of course, we look at outside of the documents that really lends itself here is really in the diligence phase. And we're finding that, you know, we're introducing a lot more of our IP specialists, a lot more of our privacy specialists into these transactions that we had done previously. A lot of times it would be, okay, if they're not really IP heavy, they're not really, you know, privacy, but now it seems that more and more the industry is trending that way. So more and more, not only are we looking to who owns the IP, is it infringing on anything, it's looking also to what data is being collected. Not only how are you protecting the data, how can you monetize that data? So it's just a lot more we're seeing in this space than just, you know, getting something from point A to point B. There are a lot more steps that are affecting along the way for more of a technology aspect. So, and with that, I will turn it over to Henrietta.
Thanks, Ronell, and good morning, everybody. I am excited to be here as well, and nice to meet you all. And hopefully I will be meeting some of you, and if not all of you, in person very soon. If you were on the call early on, you know that I'm the accountant of the group, of our trio. I'm an audit partner with Kontakt, and I currently am, my home office is New York, but currently sitting in New Jersey. We are a middle market full service accounting firm. If you don't know about Kontakt, obviously we do the assurance services, audit, reviews, compilations, tax compliance services, and we also have a sizable advisory practice that deals with ERP implementation, IT, cybersecurity, supply chain issues. We do also have a transaction advisory practice, obviously sell side, buy side due diligence, and I'm sure you have met some of my partners that are working in this group through the years and have been obviously obviously connected to Marianne, hence, my being here today. I also co-lead our manufacturing and distribution practice for the firm. So most of my clients are in that space. I work with a lot of aerospace and defense companies, government contractors, some other manufacturers and distributors. As a firm, we do have a concentration in government contracting, aerospace and defense, auto, plastics, also food and beverage, which is might not be today's conversations, but hopefully maybe another day. In terms of what Carrie and Ronell have kicked off, we do see a lot of those trends as well on the accounting side, and certainly the hot topics when we are talking to our clients are cybersecurity, not only that they have the right insurance, which obviously would be Marianne's area. We do have those discussions with them as well, because certainly want to make sure that they are protected, but because a lot of them are venturing into a lot of AI, robotics, they do have all this new technology and items that they need to be protecting, not only their ERP system and their servers and those information, but it is a much larger umbrella. So we are definitely having those conversations, and certainly there's been a lot of high profile cases lately with security breaches and ransomware. So it is definitely on everybody's mind. The other hot topic that we see is definitely around ERP implementation. And COVID sort of, I would say, bucketed companies into almost two separate categories. The ones that were holding off on the ERP implementation that they might have planned before COVID happened, to the ones that took the opportunity, having the time during COVID to go through the implementation, with not everybody being in the office or doing it at a slower pace. So that definitely has been something that we are looking at and working through with our clients, especially as they are becoming targets for either transactions or SPACs or things like that. They want to make sure that their house is in order, and that certainly involves their ERP systems and also their, how they are interpreting and managing their data. That seems to be, again, one of the items that we have seen lately over the last year and a half. There are a lot of our manufacturers, those mom and pops that were not all that concerned about, how they are getting their data out of their system or how long it took. Now they are talking to us about, speeding up that process, making sure that they have better data, that they can do their forecasting better, that they can price their products better, so that if they are will be down the road thinking about a transaction, they are ready for that, and obviously a more attractive target for a PE firm or anyone else or strategic that they might be talking to. So there's a lot going on, and I'm really excited to have this conversation, but maybe I'll kick it back to Carrie to kind of get us through the topics that we thought would be of interest to you, and certainly all of you chime in, because we would love to hear your thoughts as well.
I have to say, from the PE side, if we could get some of the lower middle market companies to really focus on some cyber and some ERP, it would definitely give you a couple of turns on your valuation. There's no doubt about it, because starting from scratch down there, it's a long road. And, just something for everyone, because I don't want to say it caught us off guard, but you know what? I think I'm going to say it caught us off guard. We have a company in Union Grove, Wisconsin, who makes rollers. So think of your mask that everybody's wearing. They actually make parts for the process, the web process to make your masks. They actually were hacked 2 weeks ago. And it was a third party, their web provider, a third party that actually got hacked, but they took our entire sort of company down for almost 3 days. So, as you're out there and you're talking to the companies you work with, this is something that's got to be on the forefront of everyone's mind. We would have never thought, this small company in Union Grove, Wisconsin had that much of a risk, and we were just dead wrong.
And I
Yeah,
think what you're also seeing is not only, so we're talking about when they get to the point that you're actually, ready to be sold, you're positioning yourself as a target, or you're looking from the PE side. But more and more, we're also taking a look at, various agreements that while companies, they may not be on the block, they may not be looking at anything, but to your point, Harry, in terms of setting themselves up and realizing, and I think, we're probably hear this more and more today, COVID, and the shift from the in-person to just doing so much of our business remotely has highlighted the need for people to, I think, look a little closer at their technology. And so they're looking more to those agreements that they're entering to, the supply agreements, the distribution agreements, those types of documents in terms of protection of looking at, some of their providers. How are you protecting our data? How are you secure so that we don't, become, an inadvertent arm of one of your breaches because of where you store our data, et cetera. So in the process of, day-to-day business, we're seeing that more as well, as more and more of the technology gets highlighted in the, in these businesses, and you're seeing the smaller players also become susceptible to, the risks.
certainly. And just to build on that a little bit more, just because I do work with government contractors, not the tier 1 contractors, but definitely the tier 2s and 3s that work with the Boeings and the electric boats, they have to be extra careful because, what supply chain they're in. So I did have a couple of my clients that had a cyber breach, and it did end up being a big issue. Not only that they were shut down for weeks and they were trying to, come back online in a systematic manner, but they also had to report this breach to their customers as well. And that can certainly hurt a relationship and, create some kinks in that supply chain, on top of all the issues that we are already having with various supply chains and things like that. So, but I would say that, if I have maybe 35 clients this year, at least 5 or 6 of them had some sort of a cyber breach. And some of them came out okay, some of them not so much. And if they have the insurance, that's great protection. But the issue is that it certainly is not fixing the problem. So we are advising them to look behind that and make sure that they are looking at, access to different systems and their backups and all that. And that's really where our cyber team comes in to make sure that they are, well protected if, if it happens down the road, actually does not go any further, or it gets, noticed before somebody can get into their system. So that really is, from my client's perspective, is the biggest issue. Like, they can definitely damage business relationships and shut down a good portion of their business for good if they are having issues and they can't remediate it, within hours. And if it's taking them months or weeks to do, it certainly can hurt, someone's business. And some of my clients are still privately held, family-owned businesses, so they really can't afford a problem like that in general. So that's why it's becoming such a hot topic, not only because, there is a transaction or anything like that, but if it's a smaller business in our, like in the middle market group, they can certainly create a lot of damage for them to continue and stay a going concern.
So the next trend that we were going to pick up on, which I know everyone here is probably tired of hearing about, but it is front and center, and it's really making a dramatic impact on the industrial M&A market, is just the ramp up in valuations. From the PE perspective, we're being forced to pay double-digit multiples for, middle market industrial companies, even to win moderately competitive auctions. But from our side, even on the other end, we're getting squeezed by our investors, who are still expecting the same levels of returns. So really, as a PE, genre in general, we're all turning to add-on acquisitions to really take advantage of multiple arbitrage that these smaller deals can provide. They're less competitive sale processes, and we can get some lower buy-in multiples there. I had a stat PitchBook sent out last Friday that just caught my eye. Their stat for second quarter of 2021 showed add-ons at an all-time high, coming in at 74.5% of all M&A deals. And I just thought, oh my God. And, you know, to everybody on this call, this buy and build strategy that the PE firms are now being forced to undertake really puts a tremendous strain on the entire M&A ecosystem. You know, the PE firms that used to do 1 or 2 add-ons per platform, we're now doing 4 or 5 add-ons. So I know, Henrietta, back to you. You know, you spoke of the urgency that people are coming to your door looking for QofEs.
Yes, it definitely has been something that we've seen over the last year or so. A lot of my companies, as I mentioned, are still family owned, privately held, but because of this attractive market, a lot of them are coming to us and say, get us ready for a transaction to make sure that, you know, we are an attractive target, or, you know, even if it's like a strategic type situation, you know, they are ready for that. So because of that, there are some of our companies that, if they are taking this seriously, it's taking them a couple of, you know, months, 6 months to a year sometimes to get themselves ready for these transactions. And some of them are jumping in head first. And that's when we see, you know, some of the deals maybe not going as well or as smoothly as we would like them to. But just to kind of like backtrack a little bit with all the other things that, you know, we see with these companies wanting to get ready for a transaction because the market is so hot, is certainly around like the data analytics. So that they can forecast better. It certainly is helping their valuation once they can provide the right data and the right financial information. So, you know, they get better, accurate results, and certainly helps the sellers and the buyers to reach, you know, an agreement that works for everybody. And the timeliness of the data certainly is very meaningful in those situations as well. But we do see that quite often, that, you know, some of these companies that I never thought some of my clients would be interested in, you know, selling or kind of like teaming up with, you know, a PE or another like strategic investor are seriously entertaining it just because of what's going on in the market. So it's been very busy for us in terms of getting them ready for these transactions, not only from, you know, upgrading a review to an audit from, you know, where I sit and from my perspective, but also from our transaction team. They are going through and helping them with the, you know, looking at the agreements, making sure that the definitions are beneficial for them. So we are taking care of that side, and our advisory practice is jumping in to get them up to speed with their ERPs and data analytics and their cybers and all that. So, and it's all just happening in a very short period of time. That's caused by, you know, the market. And some of my clients, to be very honest, I don't know if they understand. They just hearing these crazy multiples, and they, you know, they hearing the activity, but they are not, I don't know if they're fully aware of what it takes to go through, you know, a transaction like this, or what it takes to sell, or what they should be even looking for when they are talking to, you know, some of the private equity firms or other investors. So I think that's really when like Ronell comes in, and we tell them to certainly reach out to the appropriate legal team and get the right advice to make sure that they have all their ducks in a row, and the agreements and all of that they need to have in place, and they do understand what they're getting themselves into.
Yeah, and we certainly see it from both sides of the house, right? So we see it certainly from our PE clients and our independent sponsors who are, okay, so this year, yeah, we're going to do 5 add-ons to this platform because they're, you know, the market's hot and everybody's looking. And sometimes they're not always, you know, ultra large add-ons. They may, you know, I've had instances where I've done, you know, $3 million deal because there was something very specific that they wanted to kind of build out. And so not only are they, you know, looking at the, you know, the larger play, but, you know, to fill those holes with those add-on transactions. And With respect to the resources on you know, the drain on resources, the pull on resources, and I see it with the PE clients as well. A lot of times, you know, if you have multiple platforms and you're doing so many add-ons, to get the deal teams to focus, you know, and sometimes a lot of the same deal teams, there's overlap in terms of who's doing what. And when you've worked with certain clients over time, you get to know, you know what they're looking for. So it can be a lot of ticking and tying, and you're here and we know them. And so we can step in, you know, in some ways as their brain and understand and know where to go. And that's part of, you know, what we value in terms of building those relationships. So we get to those points where we can effectively act as a part of the deal team and not just as the lawyer papering the transaction. So that's what you're seeing on that side. And I completely agree with you, Carrie. That's what we're hearing from our clients. You know, we're constantly seeing the LOIs, or we're being told we have 4 of these under LOIs. And we're like, okay, because they're coming our way. And so sometimes you're asked to do documentation before you even have information. And so when the Q of E comes in, and you know, then it's a whole other set of renegotiation, and sometimes the deal does not go forward, or there has to be some renegotiation in the process. But also, just from the other side, we also represent a lot of you know, closely held companies and who've never gone through this process before. And with the valuations being so high, it's kind of like the housing market. Everyone wants to capitalize on that and get out at a really high multiple without a true understanding of what it takes. Are you getting out completely? Are you staying in? Are you rolling? You know, are you going to have an employment agreement for X amount of years? There are a lot more things than I think, you know, those players in the industrial space, because a lot of times, as we've mentioned here, there are a lot of mom and pops, and, you know, it's their first time, it will be their only time, and this is their legacy. So you're dealing with that piece, the personal nature of it, as well as the business aspect. And that can sometimes complicate it. And sometimes deals die just from that, not because it's not a good prospect from the PE side, not because it's not a great business, but just sometimes people can't let go once they realize what they have to go through in order to sell this, and the questions. And, you know, going from where you did no marketing, ran your own books the way you wanted to, borrowed, moved monies around, to now someone coming in and asking questions that may seem intrusive and telling you how to run the business, especially if you are going to play an active role going forward. You know, that bit, I've seen deals die and sometimes come back, you know, and sometimes they come back. We've worked with a lot of clients who are really invested, and over time, you know, they maintain these relationships because either they're really great for the platform, you know, there's sometimes it's just synergies between the parties, but they can't get over that emotional hump. So you're dealing with not only the business aspect, the financial aspect, but your counselor also in the emotional aspect, depending on what side of the house you are, you know, and this is all at warp speed right now in order to get everything done quicker, faster, before the next guy comes in and makes a bid and, you know, exclusivity runs out.
All right, so I've got to ask, excuse me, because it's a pet peeve of mine. We just got bounced out of the IOI phase for a $5 million industrial company here in the US. And we just like shocked. We all believe that our colleagues are very rational people. So how many people have actually worked on a deal, say in the past 6 months, that went for double digits? Show of hands. I was like, I can't believe all of our colleagues are paying 10, 11, 12 times for this small, excuse my French, crappy little company. All right, so maybe 30%. Very interesting. All right, so finally we thought we'd end the session with just some observations, and I think Ronelle already touched on some of them, on what it really takes to get some of these industrial M&A deals over the finish line in today's environment. From the PE side, the road to the finish line these days has a lot more bumps and potholes than it ever did 18 months ago. From our side, and I'm sure you guys are feeling the pain a little bit, we're definitely asking for a lot more earnouts. You know, forward-looking earnings, TTM earnings, everything is messy at this point is probably the best word for it, and uncertain, and the risk is definitely much higher than it's ever been. But we're also seeing a lot more surprises even in the Q of E. And that's really bringing us back to the negotiating table, which we never had, say, 18 months ago. I don't know what you're seeing, Henrietta, is, when you guys are doing these Q of Es, but we're definitely, to Bob's point, we're seeing these deals take big left, right turns, and it's tough to get to the finish line these days.
Yeah, I think, in general, we do see some very similar situations as well. Like there are definite, surprises here and there, or, our clients will reach out to us, and this comes back to a little bit more of our family owned businesses that might not be 100% ready for these transactions. They don't understand, some of the definitions or what it takes sometimes to get things done, and certainly it creates issues with our QOB process, and that's why we're trying to be proactive from our end to make sure that we can help them up front. But there is a lot, we also look at a lot more in our process now because of these types of transactions, certainly focusing a lot more on IT, definitely focusing on their forecasting abilities a lot more so that we can avoid situations where a deal just falls through or becomes stale because they weren't ready or we didn't prepare them enough from the accounting side of things. So those have been our focuses lately. And on the larger side, what we've been seeing, and it's not so much in the QOV side of things, but a lot of the companies are becoming concerned about their ESG, their environmental, social, and governance, like readiness, and how are they going to address a larger if they are a target for a larger buyer for a PE, what the requirements are. So we've been getting a lot of questions on that, and how they can get ready for something like that, or even what it means. So some of those questions definitely come up mid-transaction, and again, if we are working with a smaller company on our end, it becomes a little bit challenging because that's something that they never had to deal with.
I think what I would advise, PE folks and buyers is that during the meet and greet phase with the potential targets and developing those relationships, because I find that those are the deals that actually do move forward much easier when the deal teams, there's someone on that deal team that has formed a relationship with, and a trust, because it really is, I think, to a certain point, starts at trust in these, when you're dealing in these type of transactions where you have the smaller players, the mom and pops, or even, management, some of the, it's really using the time to advise them about surrounding themselves with a team, a good team, because if they can do that, and if you can help them to say, you really don't need a T&E attorney to help you with this transaction. What you need is someone who's familiar in the M&A space who can really work through this with you. Do you have a banker? It doesn't have to be an iBanker, but do you have someone in that space who understands and can explain and who you trust? Because I think that will make the process so much smoother. I've seen so many instances where either the sellers did not have, they didn't really have a team around them who can advise. So a lot of times we're doing both sets of the work, right? We're doing schedules for the sellers, we're doing, we're reviewing them. And obviously at the end of the day, and these can be, $75 million deals, $120 million deals, it's just about their comfort. What do they know? And I find that when they have a better team around them, and that helps the process go smoother. To Henrietta's point, it helps them to understand those terms. It helps them to understand maybe why, after we finally received our diligence from the legal side, from the QRV, from the tax, that we may need to come back to the table and have some conversations. And some of those conversations can be difficult, and no one's necessarily trying to take advantage of anyone. It's trying to make sure, and balance the interest on both sides of the house. So I think with the right advisors and being able to encourage them to do so up front, and not just, continue along with those who might have been well suited for the business as it's in its operations, may not be well suited for the business in its exit. So I think that is a huge, in terms of just helping the process along from start to finish, that will benefit both sides of the house.
And I see, Rob, you had a question?
Yes, thanks. My question is with respect to resilience of your operating teams. We've got a few portfolio companies. Interesting, you guys started about cyber or what have you, but then going to industrial, a lot of this is manufacturing, and we're kind of a different structure as a family office. What best practice advice do you guys are giving to folks looking at the return to normal? Because you have a couple dynamics there between the COVID stimulus phase out, and then also one thing you guys haven't talked about is unemployment or employment, where a lot of folks have been taking that, and a lot of these retail and consumer services companies are understaffed. So, and then I think I saw there was like 2 or 3 other questions in the queue here.
So from our side, on the portfolio company side, labor is the top issue. So we have 8 portfolio companies across the country. That is by far in every state the top issue. We were fortunate. We have one company in Mississippi that was really struggling. Excuse me. And the governor said, we're not taking any more stimulus money. This is done. And that has actually helped us significantly. But, as much as you'd like to hand out people money to help them, it is really exacerbating the labor market in the manufacturing industry and in any kind of industrial service across the country. So we would like to see that, scaled back and people getting back to work.
It's funny, I saw a sign yesterday that said understaffing is the new pandemic.
It's 100%.
Yes, and it's what we've seen is not only that, it's hard to find like qualified labor, but also the cost of that that labor is significantly higher as well. So some of our, my manufacturing clients are struggling, and if you look at their EBITDA, it certainly is not normalized or not normal just because of these higher labor costs and prices. So certainly, we advise them to tell that story because, a year ago or a year and a half ago, it might have been a little bit of a different situation, and those costs would have been, completely different or look, significantly different, where it would have changed their EBITDA and obviously then, the purchase price as well. So, it goes the same with supply chain. We can talk about that too for probably hours. Shortages, not being able to get the right parts, overpaying for transportation, or like really anything is just creating a very wonky looking P&L for a lot of our clients, where there is a lot behind it and a lot of explanations that need to go along. And that's when we kind of advise them to show historical as well as forecasted data, obviously, as to what it would look like if things were somewhat back to normal.
And I've got to give a shout out to Oliver. So in my previous life, I was actually in textile manufacturing for names like Jones, New York, all over the world. And Scoville Fasteners was, prior to Jones, New York, I worked for the largest infant clothing manufacturer in the world. And anyone who has a child or is a grandparent, in the crotch of a baby's garment, there's all those snaps. Well, that's what Scoville does. And Scoville, and there was a company in Japan, and they were competitors. So we were the biggest client of both of them. And I went down to Scoville and spent months and years of my life keeping them in business and making sure their quality was the same as the Japanese. And when I saw they went into bankruptcy, it just broke my heart. But they really were, you know, they got themselves in a precarious situation. The question is, you know, how often do people see healthy deals and eroding valuation about manufacturing machinery in the US? And I would say it's not really about the machinery anymore. It's really about what we started this off with, is how are you going to take that machinery to the next level? You know, you don't need to redo your entire manufacturing floor anymore. But what you need to do is come in smart and bring technology to that floor so the people and the machines work very synergistically together. And that's really the key to the US being competitive in manufacturing going forward. But from our point of view, we are real bullish on it. And the, you know, things like the infrastructure bill just popped in my box this morning. You know, those could have some great tailwinds in the industrial section as well. Think about all your intersections, redoing all of those lights and bringing in high-tech technology along with the machinery to make it all work better, faster, seamlessly. So I think this is just a really exciting place to be for the next 10 years, but we're going to really depend on those digital transformations.
Well, I think that we
I've got one more. Does lack of ESG cause a large discount, or does it kill a deal? No. You know, as long as you're not polluting the environment, where we're going to have a big cleanup bill, we like it if you have some ESG. And, you know, people underestimate what ESG is. Don't make it such a big deal. You know, if you add one diversity to a management team of 5, we added a female CFO. You know what? I increased my ESG by 20%. Awesome. You know, it doesn't have to be so dramatic. You know, think smaller. So for us, that's a no. I don't know about you guys. Do you see ESG killing deals?
No, certainly have not. I think it's more of a topic of conversation at this point. I think it's definitely going to be more important, obviously, to the larger players, but for our clients, it certainly has not been, you know, a main factor.
Same here in terms of the deals that we're seeing. It's a great value. I think it's that value add, but definitely not a deal killer.
And then, of course, we can always end on EBITDA. You guys are all some of the most creative people that the private equity industry has ever seen when it comes to serving up financials that you're making us try to figure out our risk reward. We've seen all kinds of things, from PPP loans being put into an EBITDA bucket that they say, you know, is go forward. So EBITDA right now, I would still say, is the wild, wild west. I don't know, Henrietta, how you guys are taming it, but we're just seeing all kinds of strange anomalies.
I would say we don't do anything strange. Just to give some credits to our teams, we're trying to be pretty straight, you know, from certainly the deals that I have seen, like nothing funky. But you know, certainly like the PPP loans created some creative accounting around them. Some of our clients are, you know, looking at it and, you know, expecting the forgiveness, bringing it into income. Some of them are taking them as grants. I mean, there is certainly some really creative things that they are trying to do, but we are trying to rein them in as much as we can.
Are there any other questions? Great questions, guys. And this was an incredible session, and I truly appreciate your preparation. Like, you guys rocks. Rock, I mean, amazing. Really good. And I think everybody that are local that comes on every Wednesday would agree with me that how well you guys navigated the room and even just shared about this topic. So really appreciate it, and appreciate everybody that was here. A special thanks to Loeb and Resnick and Optimatum for being always a partner to Kontakt Source, and particularly to this session. So we really appreciate you. And with that, you know, have a great week, everybody. And if anybody has any suggested topics or industry that you want to see forward, please let us know. We'd love to bring them forward in a similar topic conversations like this. So if you have a topic you want to discuss, let us know.